If your retirement is looming, say 5 or 10 years away, then it's time to make some decisions and get your portfolio in ship shape. This is because your finances can be quite complex at this stage in life. You might have lots of different pensions spread around, and the lifestyle that you're seeking and the method of funding it can have a dramatic influence on the investment decisions that you make today. So, to help me answer this on this special edition of the Steps to Investing podcast, sponsored by Brunner Investment Trust, which is managed by a big investing firm, Allianz Global Investors, I've got pensions expert Tom Selby, who's the Director of Public Policy at the investing platform AJ Bell. Tom, very warm welcome to you.
Thank you.
So Tom, as I said at the top, this is about approaching retirement and how we prepare our portfolios. So quickly, why is it that we want to be thinking about retirement 5 to 10 years before we actually retire?
Because when you're retiring and when you're choosing to take an income, then the way that your investments are structured will make a difference. So if you're, for example, planning to buy an annuity, so a secure income in retirement, then the way you invest your money will be very different to if you're going to go into drawdown, so take a flexible income. So you don't want to be waiting until the very last minute in order to make those decisions, because frankly, by then it might be a little bit too late. So having a plan 5-10 years in advance makes sense for most people.
Okay, I think that's a really good start to this, actually, because they're the two big routes that we're really going to delve into and really have a look at, which we'll get into more detail on that in just a bit. I'm going to first of all just start by asking, it can be quite complex thinking about retirement. It probably is one of the more complex financial things that you have to deal with in your life. Is this a good time to speak to a financial advisor?
Really good time to speak to a financial advisor. I mean, so taking regulated financial advice can be really good value for money throughout your savings career. But when you're at that point where you're moving from accumulation, so building up a pot, to trying to figure out how you want to decumulate it and make it last for the rest of your life, as you say, things get quite complicated at that point in time. There's a huge amount of things to think about. An advisor can help you map out all those different decisions. They can think about your whole life situation. They can help you figure out the tax implications. They can help you think about how to make sure your money lasts for as long as you do as well, crucially important. So having a financial advisor there just to hold your hand through that process can be extremely good value for money. And actually, lots of people I speak to, they'll find that the financial advisor will effectively pay for themselves quite quickly just by helping them avoid some mistakes that they might not know about if they didn't speak to them.
Yeah, it's a little bit like having an accountant, I suppose.
Exactly.
To kind of think about it. Okay, interesting. Does the government offer any help in at this point with retirement?
So the government's got a service called Money Helper, which is designed to help people with financial decisions across the spectrum, but particularly focused around their pensions. They offer a free pensions guidance service as well called Pension Wise. So unlike a financial advisor who will tell you what you need to do based on a review of your circumstances and will carry out annual reviews and in return for a fee, that guidance service will give you general pointers, but it won't give you any help based on your specific circumstances. So there is help out there, whether you're willing to pay for advice or whether you're not, but they're quite different. But yeah, Money Helper, a really good resource for anyone who's considering making decisions about retirement, but either can't afford financial advice or isn't quite ready to make that leap into taking financial advice.
Okay, interesting. And you mentioned this guidance service that they provide. Is that available at a certain age? Do you have to wait to a certain age to receive that?
So yeah, so it's over the age of 50. Once you can receive that guidance, you can get a free guidance session from the government. But they've also got a really useful website as well. So they're over the phone and in-person guidance. But if you don't want to go down those routes, then they've got all sorts of useful information that you can use to help you plot that decision. And of course, there's useful information away from the official government guidance as well. So there's loads of websites, loads of guidance, steps to investing, of course, as well. Lots and lots of materials that people can use to help them get better informed. Because as you said at the top, these are difficult, complicated decisions, and there's lots of things that you need to think about.
All right, so let's get on to, beginning with some of the planning elements. And People will be aware that they might have different pension pots lying about, different workplace schemes that they might have had. There's also the state pension as well. Can you just explain briefly what these different pensions are?
Yeah, sure. So it can seem quite confusing from the outset, but actually for most people, a lot of the decisions are relatively simple. There's just a bit of jargon that you need to work your way through. So as you say, you've got the state pension as the kind of bedrock that most people build their retirement plans around. You've then got what's called defined benefit pensions. Now, they've generally withered on the vine in the private sector, but they do still exist in the public sector. So that's a pension where if you work for a company for a certain amount of time, then you'll get a proportion either of your average salary or your final salary as a guaranteed income, depending on how many years you've been a member of the scheme. For most people nowadays, the pensions that they'll rely on in retirement are defined contribution pensions. So those are pensions where you and possibly your employer as well contribute into the scheme. You'll get tax relief on top of that as well, so an extra boost to your money. And then when you reach age 55, you can access that money flexibly in any way that you want to generate a retirement income. Now, 55 is pretty early. Most people won't want to go from that point, and we can come to that. But at that point in time, you can get up to a quarter of your pot tax-free, and then the rest will be taxed in the same way as income when you come to withdraw it. So some different pensions out there, but actually the main one people need to think about will be defined contribution pensions. And actually on that kind of the base of the defined contribution pensions is actually relatively simple.
Okay, interesting. Because I suppose defined benefit, they're a bit of a thing of the past. They tend to be more of a public sector thing. In the private sector, they don't tend to exist so much. And there's few decisions that you make with that. You retire, at a certain age, and then it will start paying you out a level of income. And I suppose it's similar with the state pension. It's quite simple there. But with defined contribution pensions, you've been building up this big pot, and now you kind of got this decision that you need to make around what you kind of do with it. If you've lost them, you can't remember where they are, can you find them? Is it easy to do that?
Really, really common problem, actually, people losing track of their pensions. So the Pensions Policy Institute, a think tank in the pensions industry, estimated that something like £27 billion of pension money is lost down the back of various sofas. And you're talking here about the average pot size being somewhere in the region of £9,000. So it's a decent amount of money. There's loads of different reasons why that can happen. So if you move house, for example, your provider might not have your new contact details. If you switch job, lots of people have loads of different jobs throughout their careers, then they can lose track of their pensions as well. But there are ways that you can locate those pensions. So the government has what's called a pension tracing service. Now, in order to use that, you'll need to find all your old pension documents, which can be a bit of a pain. Not everyone's going to have those. Equally, lots of private sector companies, including AJ Bell, have pension finder type services. So you can put in your details into those services and they'll help locate all of your different pensions, hopefully get them all into one place. And then you can decide whether or not you want to consolidate them with a single provider, which can make managing the administration of your pensions a whole lot easier than having them all over the gaff.
Okay. Why wouldn't you want to consolidate them all into one single place?
So particularly with older style pensions, sometimes they can have quite valuable guarantees attached. So if you transfer from the old scheme to the new scheme, then you'll lose those guarantees. Some older style pension schemes, particularly some pensions that were sold in the 90s or 2000s, will have exit penalties attached to them as well. So you move your money and you'll be charged for doing that. So again, not necessarily a reason not to consolidate, but something that you'll need to think about as you're going through that process, because there'll be pros potentially. So you might be able to benefit from more choice or lower charges and ease of administration. But particularly in relation to some of those older policies, there can be some cons that you need to think about. And again, it's an area where getting good quality independent financial advice can really, really pay off.
Yes, and when you're talking about defined benefit schemes that we were mentioning, if they're over £30,000, the law requires that you must have financial advice.
You have to take regulated financial advice. Yeah, it's a challenging thing for a lot of people, because actually finding a financial advisor to deal with their case can be a bit tricky. There's a shortage of financial advisors who are willing to do those defined benefit transfers, but legally, if your defined benefit pot is valued at £30,000 or more, then you have to take regulated advice before transferring that money over.
Okay, and when we talk about consolidating them into a single pot, we mean a SIP, don't we? A self-invested personal pension. What are the advantages of doing that? I suppose we talked about maybe when you wouldn't do it. What about why would you want to do it?
Yeah, so I think for most people, the main advantage would be that ease of administration. So having 11 different accounts, say, all over the place, potentially with different logins, with different services, etc. It's not an easy way to manage your money. Having it all in one place makes things a lot simpler. There's other advantages as well. So some particularly older style pension schemes, but some modern pension schemes as well, won't have the full array of income options available to you. So you might not be able to access drawdown, for example, with certain providers, which SIPs will generally be able to offer you as well. You can also benefit from reductions in charges. And this is a really important point. Even what might look like relatively small differences in percentage charges can make a huge difference to the value of your pension, particularly when you stretch that over 10, 20, 30 years. You can be talking about tens of thousands of pounds of extra money going towards your retirement rather than going towards your pensions administrator. So there's lots of different things that you can benefit from when you're consolidating, but it's an important decision, and it's something that people should take their time before making the leap.
What do you do if you've got a fair chunk of your wealth locked up in property?
So I was going to say that's challenging. Obviously, it's a good challenge for lots of people. So there are different ways you can use property wealth if you choose to. There'll be lots of people in that position. So downsizing is obviously one option, an option that lots of people, frankly, don't want to go for, but that is an option. So you can move to a smaller house and release some capital from your home. You can also go down the equity release route, for example. So you can release equity from your home. You can go through a company to do that. It's quite a complicated and can be quite a risky area as well. So again, I'd bang the drum for regulated financial advice if you're considering going down the equity release route. But there are ways to use your property to supplement your pension wealth. And actually, for a large number of particularly people who are retiring now or are just retired, property is probably going to be quite a significant part of the overall package for them, as for a lot of those people will be defined benefit pensions.
All right, so we're now at the point where maybe we're understanding a bit more what we might have to play with. We might have consolidated things, we might not, but at least we might have found all of our pensions and we know what the total amount might be that we have to play with a little bit. Now, from this, you might be thinking, so retirement's 5 to 10 years away. You're now thinking about, okay, well, what will this afford me? So how do you know what is sufficient, how much a certain lifestyle is going to cost you every year?
So it sounds like a really simple question. It's actually a question I think I probably get asked most in my various roles in my job. It's really, really difficult one to answer. It's actually impossible to answer in a generic way, because what people view of as being a moderate lifestyle or a comfortable lifestyle will vary from person to person. The different sources of income that people have. You mentioned property, for example. Some people have defined benefit pensions. Some people have other forms of wealth that they can use to supplement their pensions income. The Pensions and Lifetime Savings Association, an industry trade body, has had a crack at trying to produce some guides of how much you might have to spend in order to afford different standards of living. So they've got a basic level, a moderate level, and a comfortable level. So if you look at the moderate level, just to keep things simple, so that's a couple of holidays a year. You might be going out for dinner a few times a week. They've got a whole list of things that you might do in order to enjoy that moderate standard of living. Now they estimate that would cost around £31,000 a year to achieve. Now, the next big question is, what size of pension pot would I have to have in order to achieve that standard of living? The answer is, I can't tell you absolutely for certain, but as a very kind of rough guide, in today's money, you'd be looking at somewhere between £300,000 and £500,000 for a single person in order to achieve that level of income for the period of time that you would expect to spend in retirement. Now, that comes with all sorts of caveats. So it depends at what point you retire. So if you retire later, then you might need a smaller pension pot because, frankly, you might not expect to quite live as long if you retire at 70 versus 60. If you retire a lot earlier, then you're going to need a much larger pension pot in order to enjoy that lifestyle for longer. There's also other costs that can come into play as well. So things like long-term care, something that's very uncertain for everyone, but lots of people will need care, which might mean that actually your costs for enjoying a decent standard of living go up beyond that level. So that's a long-winded way of saying it's a difficult thing to plan for. It's important to have it in your mind, but ultimately there is no one number that's going to deliver that. It'll be different for different people.
And I suppose what you can do, you can have a look at this website, the Pension Lifetime Saving Association. You can go on, you can have a look at the breakdown of all the different costs that they've included in their calculations. And it can just form maybe a bit of a starting point for you to then figure out what your own needs might be, I suppose. Would you say that's quite a good way of looking at it?
Exactly. That's exactly how people should view it. So these, I think things like the guys that the Pension Lifetime Savings Association produce are a really useful starting point for your thinking about how big a pension pot you might need. There's other rules of thumb, which again, none of this is exact science, but for example, one that I've used previously, which I found handy when you're saving for retirement, is the point that at which you first start saving, you want to aim for roughly half your age as an annual contribution. Now, that's not an exact science, but if you start, it's a way of telling people that the earlier you start, the less you'll need to put in order to have a decent standard of living in retirement. So if you start at 20, then you might be aiming for 10% going into your pension all in. Whereas if you wait until you're 30, then you might have to put 15% a year in order to achieve a decent standard of living in retirement. Now, again, that's not an exact science, but it's a useful way of explaining the fact that things get more difficult the longer you wait to start saving.
How important is it to consider inflation? Because obviously, we're in the midst of coming out of a cost of living crisis. Yeah. So it's playing on our minds more now. How do you factor this in?
Yeah, it's a fascinating thing, isn't it? Inflation interest rates it felt like they weren't a thing from 2008 to about 2020. It's really important that people factor in inflation, both in terms of setting those goals for how much money they might need in retirement, because of course £300,000 today is very different to £300,000 in 30-40 years time. It's why investing can be so powerful. So you need to consider the impact of inflation when you're building up a pot, and then when you're turning your pension pot into a retirement income, be that through annuitization or through drawdown, again, you need to think about the impact that inflation is going to have on your money. And of course, if you just put all your money in cash, then over time, inflation will eat away at the value of that money. Now, interest rates are a lot better at the moment, but if we move back to a world where interest rates are much lower than the rate of inflation, then having all of your money in cash is just going to see its real value eroded over time.
Okay, let's get on to thinking about how you generate some income when, with this pot. And we've mentioned the two big routes, which is annuity and drawdown. Can you just explain briefly what those two are?
So an annuity is where you take your pot of money, you hand it over to an insurance company, and they'll give you a guaranteed income for life. So no matter how long you live, they'll promise to keep paying you that level of income. It can rise with inflation, it can not. There's various other bells and whistles that you can add to it, but they'll keep paying you that income for as long as you're around. Now, if you go down the drawdown route, then you've got more flexibility, so you can choose to flex your income based on your needs, whereas with an annuity, it's a set level of income, possibly rising with inflation for the rest of your life that you can't change. But if you're going into drawdown, then you'll need to think about how you manage your withdrawals in a way that's sustainable. And that's a really important point. Might be something we'd come on to a bit more, but that's one of the big opportunities in drawdown, is that you can tailor your income to meet your needs, which is great. One of the big challenges is if you take too much too early from your pot, then you might end up running out early and relying on the state pension, which is something most people probably don't want to countenance.
Is it fair to say that drawdown is a less certain option?
Absolutely, yes. So if you've got no appetite for investment risk, if you don't want to spend time reviewing your pension and reviewing your withdrawals, then drawdown, frankly, probably isn't for you, and annuity is probably a more suitable product. So drawdown is only for people who are really willing to be engaged, ideally with a financial advisor or on a do-it-yourself basis.
What happens to your annuity if you die?
So it depends on the kind of annuity that you buy. So if you buy an annuity with a spouse's pension attached, so for example, you can say to your insurance company, I want my income, and then if I die, I want my wife or my husband to have 50% of that income until they die, then you can choose to do that. If you just buy a single life annuity, so annuity just for you, then when you die, that's the end of the story. So if you live for a long time, then you'll be in the money, as it were. So you'll have made money out of that contract, like all insurance contracts. If you die a bit earlier, then frankly, the insurance company will have made money out of that contract. So it's a way of insuring yourself against what they call longevity risk, so the risk of you living for a long time. Most people wouldn't view that as a risk, they view it as a very good thing, but it's a way of insuring yourself against having to think about those kind of things, which you do need to think about if you're in drawdown.
Well, and it's fair for me to say, what happens with a drawdown pot if you die then in terms of inheritance?
So it depends on the age at which you die, so it can get a little bit complicated, but if you die before age 75, then it's possible to pass on your entire pot completely tax-free. If you die after age 75, then your pot will be taxed in the same way as income when your beneficiary or beneficiaries come to make a withdrawal. And it's actually a really important part of pensions now. The treatment of the tax treatment on death of pensions is incredibly generous, and actually for lots of people it can make sense for their pension to be the last asset they touch in their lives, because it is possible, depending on when you die, it's possible that you could be able to pass that on to your nominated beneficiaries completely tax-free, no IHT to pay either.
Does anyone, I suppose there is a third option in the sense that you could just liquidate, wait, no, I suppose it's still within drawdown, but you could liquidate your entire pot and just chip away at the cash. Is that something that people do?
So usually when people are in drawdown, they'll have a cash pot to pay their income, but generally you wouldn't want people to be putting all of their money in cash. So as we discussed earlier, there'd be the issue of inflation eating away at the value of your pot. And frankly, if you were moving all of your money into cash, that probably suggests that you don't really have much appetite for investment risk at all. And so if you're doing that within drawdown, then it's likely that drawdown's not the right solution for you. You're really going to see your spending power eroded over time, and actually you're probably better thinking about annuitization rather than just having all your money in cash. The one mistake that people really need to avoid is moving their money all in one go out of their pension pot and into a separate bank account, because you might end up paying extra income tax if you do that you don't need to pay. And as I mentioned, the death benefits treatment of pensions is really tax efficient. If you move that money out of your pension, then you're into a world where you might be paying inheritance tax on that money. And for lots of people, that'll be a big priority as they're getting older.
Let's get on to the portfolio bit then, and actually having a think about which income route you might take at this stage. And you sort of touched a little bit on this. Why do we need to think about, if you're going down the annuity route, if you're going down drawdown, why do you need to think about it now, 5 to 10 years before you retire? Yeah,
so it's really important, if you've made the decision that you're going to buy an annuity, that you think about the way that your money's invested. So for most people, if they've decided, I want a guaranteed income, say from age 65, then the last thing they'd want as they get closer to that age is for their investment portfolio to be moving all over the place. And so if you had, your plan was annuitization, but you had your portfolio invested in loads and loads of risky things, then if you get lucky as you approach retirement, then the value of your portfolio might go up significantly, and happy days. If you get unlucky, then the value of your portfolio might go down, and then just at the point you're going to buy an annuity, you look at your fund and it's gone down from £100,000, say, to £70,000. You're going to be paying the cost of having that investment risk for the rest of your retirement. Most people would prefer to have some predictability as they approach that point of annuitization. Now, on the other side of the coin, and we actually saw this quite recently with what happened to bond markets after the quasi-Kwarteng budget in particular, there were lots of people who were, this all sounds a bit techie, but it's not too bad, who were invested in what's called annuity hedging funds. So the aim of those funds, very simple, is that you invest in this fund and it will move in the opposite direction to annuity rates. So the idea is that you invest in the fund, and then as you approach the day that you're going to buy an annuity, then if annuity rates spike, then the value of your fund will go down, but you'll still be able to buy the same thing because the rate that you're getting an annuity goes up. Now, lots of people were invested in those funds historically who'd actually changed their mind and wanted to go into drawdown. So they were in a product that was hedging against annuity rates, but they weren't planning to buy an annuity. And so what happened was that bond prices massively went down, and they ended up sitting on losses of 10, 20, 30% when they thought they were in something that was no risk. So it wasn't no risk, it was that it was hedging against a product that they were no longer planning to buy. So I think that's two examples of where if you get it wrong, then you can end up in quite a difficult place. So it's why you, regardless of whether you go into drawdown or buy an annuity, thinking about your investments as you approach that point in time is really important.
So it's not just the fact that you're in risk, it's actually the appropriate risk for the appropriate goals that you've actually got. And if you suddenly lost 20% of your portfolio and then you decided to buy an annuity and you then that's it, set in stone, it has an enormous impact on your retirement from that moment on.
Significant impact. Yeah, I spoke to lots of people. I did some radio phone-ins about it. People who had seen their retirement plans essentially torn asunder by it because they didn't want to lock into a guaranteed income product for life. For lots of people, that'll be an appropriate route. But if that's not what you want to do, then you're left with a terrible choice of either buying a product that you don't really want because you've been hedging towards that, or sitting in your fund and praying that things are going to turn in your direction, which there's no guarantee of. So most people don't want to be, a hostage to fortune when it comes to their retirement income plans. And if you're planning to buy an annuity, then getting everything set beforehand is really important. If you're going into drawdown, can be slightly different. So for example, if you're going into drawdown at 65 and you're healthy, then you might still have another 25, 30 years of good life to go. So actually the changes that you need to make in your investments if you're planning to go into drawdown, for lots of people there'll be no change at all. You might be wanting to think about generating an income as you go into drawdown, but as you build up to that point, there might be very little that you need to change in your portfolio. So it just depends on the route that you're planning to go down.
Well, let's actually explore those two routes. So we're 5 to 10 years away from retirement. What we're thinking is, I'm pretty risk averse. I'd really like some, a guaranteed income stream. I'm thinking about an annuity. What do you then do with your portfolio? You said basically what we need to think about is stabilizing its value so you can rely on that value at the moment that you do retire. So what should you be doing? De-risking it effectively?
So de-risking it. So there are funds that will do that for you. So those annuity hedging fund type funds that I mentioned, so they'll do it for you. So they'll move in the opposite direction to annuities. So things become more solid as you're approaching retirement. Or you can choose to move your fund into cash or cash-like investments. Now you might be giving up the possibility of some investment returns in doing that. So you want to make sure you're in cash investments that are going to at least give you some money back to fight the impact of inflation. But it's, for most people, it's worth it for having that certainty of knowing what their fund value is going to be as they approach the point when they're going to turn their money into an annuity, so they can plan for the rest of their lives.
Okay, so it might be going into, as you sort of said, annuity type hedging products.
Yeah. It
might be just removing some of those riskier investments, things in shares, into more things like bonds and
exactly.
Stuff like that.
Yeah.
Okay. And then if you're thinking about, no, I want more freedom. I'm thinking, my risk appetite is there. I'm thinking about drawdown. How do you then approach this 5 to 10 years away from retirement?
Yeah. So the answer, the frustrating answer is it depends. So it depends on how you're going to take your income and specifically how much income you're going to take. So lots of people who go into drawdown will do so in order to get their 25% tax-free cash, because that's a decision you need to make. You need to go into drawdown in order to access your tax-free cash. If all you're planning to do is take that tax-free cash and leave the rest of your fund invested for 5, 10, 15 years, then actually there might be no particular change that you need to make to your portfolio investments other than perhaps doing some de-risking around that 25% portion so you know the tax-free cash that you're going to get. Equally, if you're planning to access your pension and take a whole load out for specific purposes, then again, you might want to think about de-risking around that point, because if you've got a specific thing that you want to spend your money on, then that might be something that you want to do. But obviously you need to think about the sustainability of your withdrawal plan if you're going to take a whacking great amount out, as well as the tax consequences of doing that. For a lot of people, and I think the vast majority of people, they'll be going into drawdown and thinking, I'm going to take a regular income from this portfolio. So that doesn't mean that you need to fundamentally change the risks that you're taking as you approach that point in time, because you're planning to drip feed an income from your fund potentially over 25, 30 years. So you still need to be comfortable with your risks, but you don't necessarily need to change the balance of your investments. It'll depend on your priorities. The one thing you'll probably want to do is think about moving towards income generating investments. So you want your portfolio to give you an income. So you want the investments that are underpinning that to deliver you an income as well. And in an ideal world, you want that income to be strong enough that you can almost live off the natural yield of that portfolio and not need to worry about drawing down on your capital. And you can potentially then leave some of your money behind to loved ones or use for different things.
When you say income generating assets, what type of assets are there that generate income?
So there are investment funds that will help you do that. So you can pay a fund manager, which will give you they'll invest in various different things, which will pay out dividends, and then they'll give you the income from that. You can do that through what's called investment trusts as well, which I think an underused type of investment vehicle in the UK, but can be really valuable to people. They can smooth out your investment income over a long period of time in a way that other funds can't necessarily do as well. It's also, of course, possible that you could build up your own individual investment. So you could invest in individual companies. You could live off the dividends that they produce for you. Now, if you're going to go down that route, that requires you to be a really engaged, active investor, and you really need to think about the diversification of your pot. So what you don't want to do is invest in 5 or 10 companies all in the same sector, because if that sector tanks, then your retirement plans are up in smoke. So for most people, it will be paying a fund manager who's got an aim to deliver a certain income, whether that's an investment trust or whether it's not, in order to have a diversified portfolio, in order to get what your hope's going to be a nice secure income that's going to last for throughout your retirement.
Yeah, I mean, investing in individual companies does come with quite a fair few risks that are diversified somewhat when you invest in portfolios such as investment trusts, as you mentioned.
Certainly not for me picking companies. Absolutely not.
Yeah, it's a tough thing to do. And you mentioned investment trusts there. They have a revenue reserve, which means they can set aside 15% of their underlying income that they receive in a year, put it in a pot, and then use that in years where maybe the underlying income isn't so good, in order to smooth that income stream over time.
Yeah, that's been something that's been really attractive for lots of people, because we've had a lot of uncertainty in the last few years. I don't know if you've noticed. So, during the COVID pandemic, for example, and during the recent crisis we've seen, lots of investment trusts have actually been able to continue paying investors a dividend, so continue paying them an income, even then when things have been really tricky. And that's because they've been able to hold back some of that income that they had stored up from some of the previous good years. So if you're wanting a kind of stable, reliable income, then investment trusts are definitely something that's worth exploring.
Okay, well, on that note, a very big thank you to Tom Selby and to our sponsors, Brunner Investment Trust. If you would like to find out more about them, then please visit their website at brunner.co.uk. They are a global investment trust investing in company shares around the world. Please don't forget, though, as with any investing, it comes with risk. So the value of what you put in can go down as well as up. Until next time, goodbye.